Hello everyone, and welcome. This is Deep Dive Stocks. My name is Justin, and today we're going to be looking at VWAP. VWAP is a pretty popular metric in the market for a variety of reasons. It's easy to read, easy to interpret, and for the most part, it seems to be pretty accurate. That's why I thought it might be a good video to dissect VWAP, figure out what's going on below the surface, and how we can anticipate it might behave in a variety of circumstances, and then we're going to expand on that and develop our own metric, LWAP. We're then going to compare VWAP and LWAP to see how they do, and it's pretty fun, I think. So let's get started. Today's topics, as I kind of already suggested, but we're going to gain some familiarity with VWAP. We're going to look at how VWAP is a liquidity metric, although it is a slightly odd one. We're going to talk about VWAP strengths, and then of course we're going to talk about VWAP's weaknesses. So what is VWAP? If you Google it, you get the volume weighted average price, but what does that actually mean, and what does it actually tell us? Well, volume weighted is fancy math we just divide by volume. Average price just means that we take all of the prices and we average them. All right, thank you for coming, guys. This has been my TED Talk on VWAP, and I'll see you guys next time, right? We all wish it was that easy, right? So let's look at the expression of VWAP, but unfortunately it's not, is the end of that expression. Let's look at how VWAP is given to us. And I say that because you can't really, what's the expression? Accuse quants of knowing math. So what is this monstrosity here? But this monstrosity is VWAP. And what does it mean, right? So let's look at, can I move this? All right, perfect. So let's look at it term for term. PJ is the price over some interval J. And that J could be the 5-minute candles, the 10-minute candles, 20-minute candles, so on and so forth. And PJ is really the high plus the low plus the close of that interval divided by 3. That's our average price aspect of VWAP. The sum of PJ means that for every interval, we just add the preceding values. So that means, for instance, suppose I have 3 buckets, bucket 1, bucket 2, bucket 3, and in those buckets are a random number of sodas. Suppose I wanted to know how many sodas I have in total. Well, in math, I would write J to 3, because we have 3, and then the amount of sodas, S, in each bucket, J. And so if I had 2 sodas here, 3 sodas here, 10 sodas here, this would be 2 plus 3 plus 10 equals 15. What's cool about this notation, though, is I can also specify if I want specific intervals. So I want to know the amount of sodas between bucket 2 and 3. So that would be 3 plus 10, because I go from 2 to 3, and that's 13. We're not going to get too much. Obviously, this isn't a algebra course, but these fancy math letters aren't all that intimidating once you kind of see what's going on below the surface. So this is just saying add up all of the PJs, starting from the first bucket all the way to your current bucket. And so VJ is just the volume of that particular interval. And in the same theme, the sum over J of VJ is just the sum of all of the volumes. So if we were to translate this equation into English, we would just say the volume weighted average price is the sum of the average prices multiplied by the volume of interval J, so like your 5-minute candle, divided by the total volume. Well, I don't know about you, but that really still doesn't mean that much to me, right? It is one thing to know what something stands for in words, but to get it, to feel it, we have to play with the data a little bit. So let's do just that. Let's take this equation and let's apply it to 3 examples. In this example, we're going to be using VWAP on a 5-minute scale, and the previous VWAP value was 6.5. We know, because the 5-minute values just changed, that our high was 10, our low, I think, was 6, and our closing value was 7. So the first thing we do is we add 10 plus 6 plus 7 divided by 3, and that gets us, I think, 14.1. No, this is 7.6, sorry. And then we add the previous VWAP value, which is 6.5, and that gets us 14.1. Then let's suppose that the volume of this 5-minute candle was 100. And the sum of all of the volumes, including this 5-minute candle, was 1100. Oh boy, let me make myself smaller. So that means we take 14.1 times 100 is 1,410. And then we divide 1,410 by 1,100, and we get 1.28. So our new VWAP value is a staggering 1.28. Let's do this again, but this time let's adjust the volume a little bit. Let's kind of get a feel for how volume changes. So let's say in the same 5-minute candle, but our volume was 300, which puts our total volume now at 1,300. I had to make sure I was doing my math right. And again, we start by finding our quote-unquote true value. So that would be 10 plus 6 plus 7 divided by 3 is 7.6. And then we add the previous VWAP value, gets us that 14.1 again. And then we multiply that 14.1 by 300, and that gets us 4,230. We then divide that by the total volume, so 4,230 divided by 1,300, and that gets us 3.25 as our new VWAP value. So it's pretty straightforward. Let's try one more. I don't know why I'm erasing all this because I'm going to need it immediately next. But this time our volume, we're going to up it again. We're going to say it's 900. So our total volume is 1900. So we start out as usual. We do the 10 plus 6 plus 7 divided by 3 is 7.6 plus 6.5 equals 14.1. 14.1 times 900 is equal to some obscenely large number, 12,690. And then we're going to divide 12,690 divided by the total volume, which is 1900. And our new VWAP value is, drum rolls please. Actually, before I give the value, what do you think it is? You don't have to do it, but is it going to be higher? Is it going to be lower? Have we noticed any trends? Okay. The 6.67. So we did indeed go up. So that's one of the cool things about VWAP. It seems that if volume is greater in a 5-minute candle, or the relative volume is greater, it seems like the value of VWAP increases. So there might be something to keep in mind. Now VWAP, this is going to be a little bit for the math nerds out there, but VWAP needs to be parsed out a little bit. We'll put it that way. So let's go with the original expression. And let's actually just separate this out, because I think this becomes a lot more clear what's happening. We have two distinct entities to VWAP. We have the running price, or running sum of averages, I don't know if that's a good color to use or not. And then here we have the relative volume, or the volume ratio. And this is going to be important to keep in mind, because when we think the change in a stock's price per change in volume, that should immediately make us recognize, or it should ring some bells in our mind, that we're just talking about liquidity. So if you're monitoring or measuring the change in a stock's price versus how much movement or how much activity or how much volume it took to move that stock, you're simply just talking about liquidity. And we can see that, I think, much nicer here. Moving on, let's look at this liquidity measure. Let's suppose that VJ is equal to 100 and the sum of VJ is equal to 1100. This means, how do I want to put this? And then let's look at a few examples. Let's take the extremes from before. And let's say that in both cases, the change in the stock's price was 1%. So we have two different volume profiles. And in both profiles, the change in the stock's price was 1%. And the question is, which one of these is a liquid stock? And if we're not too certain on how to parse that out, let's think about the characteristics of what is a liquid stock. Well, that means that things are running smoothly. For instance, if I come in to the market and I want to sell one share, I don't want the market to tank when I go to sell one share, right? Like or especially if I need to sell two shares. I don't want to come into the market and sell one share and have the stock's price plummet. I want to be able to come in, sell one share, and then sell my next share at approximately the same or greater value. So when we talk about the volume per price change, and quick plug, if you haven't, this stuff might make a little bit more sense if you check out the live chat on liquidity, where we went into all of these liquidity ways of thinking about liquidity in some pretty hefty detail. But when we're talking about liquidity, if a stock is stable, what we want is a lot of volume to little price movement. That is a liquid stock, because that means that you can come in and sell and buy, I can come in and sell and buy, and we don't have to worry about the stock moving 10, 20, 30, 50%. We don't have to kind of worry, is this going to be a Tesla moment where I go and I buy 5 shares and Tesla just is going to run 10%? Like, or I go to try to sell shares and it drops 100%. Like, that's not a liquid environment. So with that in mind, which one of these, A or B, represents a liquid environment? Well, it would be B, because more volume went into moving the stock 1%. So this tells us that as VJ increases, so as the change in the volume increases, a little bit of math notation, we typically see more liquidity. And then as the change in the volume decreases per an equal amount of share price change, this is less liquidity. So what does that mean for our ratio? Well, let's check it out. I'm actually just going to erase this because we don't need real numbers now. Suppose that VJ is approaching this. What does that mean? If I say the volume of this 5-minute candle is approaching the total volume, well, that means that VJ is really high, right? So if we have 900 on this candle and our total volume is 1900, VJ, this 5-minute candle, represents the lion's share, almost 50% of the total volume seen up until this point. So as VJ approaches the sum of the volumes, what does this mean for our ratio? Well, our ratio, VJ over the sum of the volumes, is going to approach 1. As VJ gets closer and closer and closer, so we can think of it as this. So if we look at 1 over 5, 2 over 5, 3 over 5, 4 over 5, 5 over 5. As VJ, which is this top line, increases, we see that this ratio, 0.2, not 2, oh wait, it's 5, right? So 0.4, 0.6, 0.8, 1. So as VJ gets bigger and bigger and bigger, the ratio approaches 1. And conversely, as VJ moves away, I don't know how to actually represent that. We see that this ratio, what do you think it does? It moves towards 0. And that would be the same as if we just reversed, went 5 over 5, 4 over 5, 3 over 5, so on and so forth. So what this ratio is telling us, or we should say like the influence, how much weight this ratio has, the influence of this ratio increases if volume goes up and decreases if volume goes down. Pretty nifty. And again, this is kind of how we measure the liquidity aspect. Well, it's the portion of it, right? Because it's the change in the volume, or the ratio of the change in the volume, the relative volume. And what that means, before we get into the price path, if we add the other term, is that a surprising fact about VWAP, if liquidity increases, VWAP just approaches the moving average of the price. So we see it's really not that special, because as this tends towards 1, well then this just becomes the sum of the average prices. Conversely, if liquidity decreases, or the relative volumes per price movement, then we see that VWAP, it just kind of gets scaled down. Right, as this moves towards 0, this increasingly gets smaller. Its magnitude gets smaller. So this is some pretty interesting characteristics about VWAP. Another thing that a curious thing about VWAP is we said that PJ was defined as the high plus the low plus the close over 3. Now let's look at a quick analogy. Suppose I wake up and I walk 10 meters from A to B, and I walk 5 meters from B to C. How much did I walk? Well, easy, right? I walked 15 meters. I walked 10, and then I walked 5. What would VWAP say we walked? The VWAP would say we only walked 7.5 meters, because it would take 10 plus 5 divided by 2 And that gets us, I think, 7.5. So when we talk about the price path, we see that VWAP diminishes or undergoes a dimension reduction on the price path. It only takes the average values and the volume of that average value as opposed to the actual price path. Like what if, for example, in our previous example, we said that the volume was 900. Well, what if this 10 meters was 750 of that volume and these 5 meters were that remaining 150? That tells us something. This was a lot more liquid than this portion. So, but we lose that information when we talk about VWAP because VWAP excludes the price path. It only includes the average price. But that's worth keeping in mind. Just the idea that the VWAP is blind intra-interval, right? So essentially whatever happens if you're using a 5-minute candle for VWAP, whatever happens inside of that 5-minute candle, VWAP is blind to it. It only acknowledges the high, the low, and the close. So even so, if we take like an extreme example, back to our, let's write this real quick. PJ is equal to the high plus the low plus the close over 3. And then say we had 10. Remember we said 10 was high, low was 6, and close was 7. So let's do let's draw a candle, or let's just draw like a graph. So 10, 6, 7. Now it would be really cool if the stock went like this, right? But what if the stock did right? What if it had a significant amount of movement inside of that 5-minute candle? VWAP is blind to it. These two, I'll draw it a little nicer. These two are equivalent in VWAP size. But we can clearly see, if we were looking at that on our time chart, that something very curious is happening. So with our example, and with all of this fun information that we've added, let's look at how VWAP changes as you change the average price, the next VWAP value, and how you change the volume that it takes to get to that VWAP value. And we are still starting with a 6 with the same previous VWAP value from before. And each one of these lines represents the next VWAP value. So this is 10, this is 8, this is 7, this is 5, and this is 1. And what's curious is we see that even in times where the next VWAP value is greater than the previous VWAP value of 6.5, so 7, 8, 10, there are times when the subsequent VWAP value will be less than 6.5, depending, and for $1 always, depending on the volume. So if there's less than a total aggregate volume of around 3,000, even though your next VWAP value is 10, it will be lower than the current VWAP value. And conversely, we see that if the change in the volume is greater than these values, or greater than certain volumes, then the next VWAP value, even if the next 5-minute candle's average is less than the current VWAP value, say 5, if there's sufficient volume, then the next VWAP will be higher than 6.5. This also shows us the nature and the way that the VWAP responds to volume. It's a log graph, right? And it maxes out, which is another finding about VWAP. There's a little bit of the math nerdiness, but we notice that as volume increases per 5-minute candle, we notice that its influence on the change of VWAP. So for instance, if we look at the $10 and our volume is near 0, and then we go to 2,000, it's quite a significant jump. But if we go from 2,000 to 4,000, that's slightly less of a jump. 4,000 to 6,000, even less of a jump. 6,000 to 8,000, even less. And this will continue until eventually volume has no effect, as this curve flattens out. So VWAP has a diminishing return when it comes to monitoring liquidity through volume and how it relates to the change in price. Another curious finding. Well, so let's actually backtrack that for a little bit. So because there's a diminishing return in the amount of volume, what does it tell us about VWAP's accuracy throughout the day? Say you're using a 5-minute VWAP candle and it's 2 p.m. Well, VWAP is really not going to be changing at all, right? At least per volume, or per volume. Yeah, per volume, right? So as the day progresses, or as volume increases, which it will, obviously volume can't decrease on a stock. As volume increases, or as the day progresses, VWAP literally again just falls down to the average running price. The aspect of VWAP that is VWAP, the volume weighted aspect, loses its significance. It becomes a static number, just a scalar. So it just adjusts VWAP, or it just adjusts the running average of the price over whatever interval. It just essentially will become like a number, like 0.5, and then that's it, as the change in VWAP flattens out. Another thing worth noting is that VWAP, because it is more sensitive to low volume in terms of changes than high volume, and because we started at 6.5 and here's our 10, if it takes little volume to move a significant amount versus a lot of volume to move a significant amount, we again see the liquidity aspect of VWAP. So notice that VWAP in highly liquid environments, there's a lot of volume, doesn't move as much as VWAP with low liquidity. So if anyone ever says VWAP's not a liquidity metric, they're wrong. Show them this video. But again, the problem is that it is a diminishing return liquidity metric. After a certain point, which is where I assume people started talking about anchoring. Because let's look at an example, just a fun example real quick. Suppose we have a 5-minute candle and its high is 10, its close is 7, and its low is 6, right? Let's suppose we have another candle. And it really doesn't move that much, but let's say that this is a 100 volume and this is a 1 million volume. And then let's suppose we have another candle and it's pretty extreme, right? And let's suppose the volume was back down to 100. Because of the pure magnitude of the one-off 1 million volume, on candle number 2, 10 minutes into trading of the season. If we go back to our ratio, we see that VJ is the sum of all of the volume. We had 100 volume, and then we went to 1,000,000 volume, and then we went back to 100 volume. So VJ, until enough hundreds pop up to equal around another 1,000,000, this is static. It's just going to become some number, 1. And so from this point on, what is VWAP? If the ratio of the volumes is 1, well, then that means that the sum of the price over J is just equal to the running average of the prices, because VJ over the sum of VJ is 1. So within 10 minutes of the market opening, we now have an invalidated VWAP. It's essentially reduced just to a running average, or the sum of the running averages, which is slightly even worse. Right? So that's where I think anchoring started to pop its head up, because people started to realize VWAP only works if things are running, I guess, like equally throughout. Right? As soon as there is some big occurrence, some cataclysmic event, some crazy movement in volatility, VWAP loses its, what makes it slightly more than a running average. And so we can now anchor VWAP. We just set a new point. We forget everything that's happened before, and we move forward. Kind of sounds like my coping mechanisms. But you can't do that in the market. It loses you money. And so I think this graph is actually pretty cool. I would recommend just studying it, getting the feel for it, how different VWAP, how different values, because we can see here, essentially this is done. This is just going to flatline, right? Even though this is, but the one up here is slightly going on a little bit more. So if you are going to study this, just to recap, these are the next high plus low plus close over 3 values. So they haven't been added. So this would be like, so this would, well, I'm not going to actually do the math for all these, but yeah, good to know how VWAP, or how VWAP behaves in different environments. So all of that to say, VWAP does have some strengths. It is adjustable, which is convenient, right? You can look at it on the 10-minute, the 5-minute, the 1 day, the 1 week, the 1 month. It really doesn't matter. The only thing is that if you look up a lot of warnings, will say like, don't use like between days, right? Don't use the same VWAP between days. And that just has to go back to this and this, where after a while you have to reset VWAP, or it just essentially becomes a running average of the price. Because once you get enough volume, the VWAP value flatlines, it changes. You don't get that responsiveness you get when you have little volume. So although it is adjustable, you can't use it too much, right? But if you, but don't use between days. Oh, but the thought was that you can use VWAP on the level of the day. You can use it to monitor like the daily VWAP. That's fine. But you're going to have to choose some arbitrary point to reset it or to anchor it. Forgive my handwriting. So adjustable, so that's convenient. But it's also, it introduces relativity, right? Relativity, if that's a word. It is not. Anchorable, being anchorable was convenient because you can just choose, all right, I'm going to restart. The problem with that, though, is when do you choose to just restart? Is it Do you have objective measures? Or do you just go, oh wow, that was a big volume bump, I guess we have to re-anchor our VWAP? It is although there is a strength that it is a relative liquidity metric, in that you can get a really good view of like what liquidity is like at 12 p.m. versus 8 a.m. So if there is an event, you can say, all right, well, VWAP is a lot more active now than it was before. Therefore, there's probably something going on with the liquidity. Whereas if you're, JPAL's talking and VWAP's not really moving, well, nothing probably is going on with the liquidity unless a big volume event has occurred and you didn't adjust and anchor your VWAP appropriately. But there are times and places where a relative view of what is going on is beneficial. And its big benefit, I think, and the reason why it's called a fame really, is that it's just super easy to interpret, right? If the VWAP is above the price, then that's bearish. And if VWAP is less than the price, that low, then it's bullish, right? And you really can't get any more simple than that. It just is what it is. But that is a strength. You don't want to sometimes have to dig through 6 different graphs and see how things are intermixing within one another. You just want a straightforward, what are things looking like? Is there liquidity below me, or is there liquidity above me? Its weaknesses, though, is it is reliant on past performance. You never really want to ever use, and I'm going to repeat this again, you never want to use a market metric that is reliant on past performance. It is the most asinine thing you could ever do in your entire life. End of rant. But it is reliant on past performance, which means that, again, you have to decide or choose if you want to anchor or readjust depending on something that has happened in the past, because that might affect the view that VWAP gives you for the future. You see how that's a problem? Like if something cataclysmic happened an hour ago, the remnants of that will still be in the data that you are looking at right now. Now that may be useful sometimes, but a lot of the times it's not, because the data you are looking at right now should be monitoring directly the consequences of the cataclysmic event, not the cataclysmic event itself, if that makes sense. So it is relying on past performance. And if Dr. Phil taught me anything, it's that past behavior, actually he would not agree with this, past behavior doesn't beget future performance. It does have this incomplete price path, so it has a dimension reduction to it. It doesn't capture all of the movement of the price, but it does capture all of the volume, which is an issue, right? If the price goes like this and the volume is 1 million versus the price going and the volume is 1 million, those are two very different things. And you should capture that. It is also directionless. And by that I mean, notice that open, close, if the price went up, if the price goes down, that is not included in VWAP, which again might be of an issue if you use VWAP to identify zones of liquidity, because, well, how do you know if a stock is going up and there's liquidity is getting better versus if the stock is going down and liquidity is getting better? Those are two very different fundamental behavior traits of a stock. And VWAP can't capture that because it doesn't actually include, I think it's like a little bit of a mix of these two. It doesn't include the price path and it doesn't include the open and close aspects. And VWAP is a little bit inverted. We noticed that the more things that happen, like the more volume, the less VWAP changes. And so that can be a little bit of an issue. You should want something that has an equal kind of, everything has an equal weight. If liquidity gets bad and then it goes from bad to worse, and then worse to terrible, you would want a metric that identifies the gradations in the differences of these like liquidity steps. And so let's improve VWAP. Now, small disclosure, this part of the talk, I was going to introduce how we can improve VWAP, and then we were going to piece together a metric to replace VWAP. But it turns out that the metric pieced together to improve VWAP is exceptionally good. And so full disclosure, am going to keep it close to the vest and keep it for the deep dive stocks community. But we are going to briefly discuss it, and we are going to briefly look at the results and the comparison with VWAP. Because again, the point, kind of the original point of this was that you don't have to be some super quant to come up with metrics that can beat things like VWAP. You just spend some time, analyze VWAP, get a feel for it, figure out what it has going for it, what it doesn't have going for it, and then you just add the things that it doesn't have going for it, or you switch some things around. For instance, one of the first things I noticed was that we needed a metric that measured liquidity that wasn't linear and it wasn't inverted. And I wanted a metric that the more illiquid a stock became, the more the metric responded to that. When a stock is liquid and everything is running smoothly, I don't need a metric to tell me this. But I want my metric to shine when things are getting rocky, when things are getting crazy, right? And that's exactly when VWAP underperforms. That's exactly when VWAP underperforms. When things go crazy, when things get hectic. And I wanted to invert that. I wanted to actually get something that its performance improves as things get crazier. I wanted to remove the dependencies. So I don't want any association with past data. If this is a 5-minute chart, so every candle is 5 minutes, I want every candle to be inspected individually. I don't want anything associated with the previous candle. So I don't have to anchor, I don't have to adjust, I don't have to worry about, was this event that just occurred going to affect how my metric responds and the values that it gives me. But with that, I did want a complete price path. So I did want high, low, close, and open. So we do have, and the, high, low, close, open, and close to close. The change. So we weren't able to remove all of the dependencies. We do have the close to close relationship, but it's only one candle's worth, so it's not terrible, I suppose. Still not 100% happy with it, but it is what it is. The other thing is I wanted to remove completely any aspect of a running average. If your metric that you're using has a running average, you should be running from it. Their running averages are very visually pleasing, and I think they have a group mentality efficacy. But the problem with them is, again, it is past performance based. And that's why a lot of these lagging indicators, and even the indicator that is going to replace VWAP, LWAP. It is a lagging indicator, but the reason why they're so typically not predictive is because they're based off of previous performance. It's terrible, right? Like, imagine if future stock prices could be predicted by previous performance. You wouldn't think that it would be so difficult to predict future stock prices, seeing as we have close to 100 years of stock data, right? We just need 101 more years. So, introducing LWAP. It's a nonlinear liquidity measure. It's not dependent on historical data other than the close to close. It has a complete price path, so it's high, low, close, open. It's easy to interpret, just like VWAP. So if LWAP is above the stock's price, this is bearish. If LWAP is below the stock's price, this is bullish. And it turns out, and the reason why I'm being a stickler and keeping it within the deep dive stocks community is that it is incredibly accurate. Hey everyone, sorry for the interruption, but while I was editing, I realized I didn't quite make the connection between LWAP and VWAP, so I figured I would jump in and do that. As we saw in the video, VWAP does have some strengths, but it does have some weaknesses. So in trying to work around those weaknesses, LWAP was created. But what's unique about LWAP is it contains everything that VWAP contains. VWAP is a metric that is just based off the price and the volume. And LWAP is just based off of the price and the volume. That's what makes LWAP kind of so impressive, is that it's really just a rearrangement and an understanding of how liquidity works that allows us to go from VWAP to LWAP. All right, guys, I'll let you get back to the video, and I'll see you guys next time. Bye. So let's have a peek at it. Here's LWAP for SPY. And this is on the daily. And again, so just like VWAP, LWAP can be adjusted to any time frame. You can use the 30-second candles, you can use monthly candles, it doesn't matter. But we see that in classic form, so this is up because the price is below LWAP. This is down because the price is below LWAP. And I'm kind of grazing over like the times, like here, obviously that would be a mistake. If you went long here, would not be a mistake, that's up. So here is a profitability zone, here is profitability. So you get the gist, right? The LWAP on SPY from, what is this, for the past year, has been very responsive to SPY's movements and almost obscenely good at telling us when to go long and when to go short on SPY. I think by counting it, and I think there's some testing going on, but I think there's characteristics associated with knowing when kind of like a quote unquote fake out. But again, there's only certain expectations you should have when you have a lagging indicator. And as far as lagging indicators go, this one is particularly good, but it has a ceiling because it's a lagging indicator and it's based off like the stock's price and stuff. But we see just like LWAP or just like VWAP, it is easy to read, accurate, and can be adjusted. And you don't have to worry about all the nonsense of anchoring and adjusting and diminishing returns as the day goes on. And in fact, if we compare the two, so I did a daily VWAP versus the daily LWAP for SPY, and what a stupid difference. So sorry for the color mix up, but the gold here is the close and the gold here is SPY. I wasn't thinking when I did the graphs. But look at VWAP doing some wild things, right? Now, you know, what should I say? Credit where credit is due. VWAP is still, for what it's worth, accurate, right? So we have here is down and VWAP is above the price. We have here is modestly up and VWAP is below the price. We have here, and so credit where credit's due, right? Like it still does its job, kind of, right? It's a slight up maybe, but it's not, and I imagine this is the same on all time scales, it's not as accurate as anyone would ever like, if anything ever could be. But we see that the same intervals that are going on over here are much more cleanly dissected out with LWAP versus VWAP. Pretty nifty. I mean, which one would you rather trade with, right? Here's QQQ just to show, and I'm not obviously going to run through every one, but I mean, I did ETFs, I did individual equities, I did like high volume equities, low volume equities, and it stands the gamut. It does just fine everywhere. And in fact, one of the cool findings is that LWAP is most performant in 2020 and 2022. Why? Because those are the most volatile times. 2021 is okay. It still gets a profitability. But in 2020, I mean, you should see some of the backtesting. I have backtesting here, but I don't know if I didn't include 20. The 2020 during the like February, March of 2020, chef's kiss. Beautiful. Because again, the more volatile and the more you need the data, the more LWAP shines. Another thing I did, if anyone here is familiar with VWAPs, is I looked at LWAP and overlaid VWAPs on top of it. And the cool thing is that the two metrics have absolutely nothing, zilch, zero, nothing in common. And yet we still see VWAPs spiking during LWAP crossover events, which I think is pretty nifty, honestly. That I'm actually blown away by this. Because we also see that when there are crossover events and VWAPs doesn't spike into the inhibition zone, it's a fake call out. It's a fake switcheroo. So I think that that's pretty nifty, pretty cool. But what it does, such as here, it's not a fake. It's not a faker. Then the next step, because this seems too good to be true, was to simply backtest it. And this is a very simple, if VWAP is below, go short, or go long. If LWAP is above, go short. And it's a standard backtest, so you either go long on the 10 shares or you go short, depending on which way LWAP changed. And we see that if you started doing that at the start of the year in 2022, January, and you traded on LWAP, you would have, after doing 10 shares, I think it's about $200. Or if you bought 10 shares on SPY and held it, you would have about negative $800. So a $600 profit of like gross profits with LWAP. Pretty nifty. And I'm doing more testing on this. Here's the trades. I just thought it was interesting. Because again, like there was no inclusion of like determining if a switch was a fake out or not. So it was just traded. So if after one of these lines, the next day at the opening price, the position would be closed and then the next position reopened. And so we see a good amount of trades occurring. And overall, this very nice profitability. Very nice. So in summary, VWAP is a very good proxy liquidity metric. Or I take all that back. VWAP is a proxy liquidity metric. I don't particularly think it's that good. And I think I presented some sufficient reasons above as to why that's the case. It has diminishing efficacy as the day goes on. Large intraday events can obscure and completely annihilate VWAP's efficacy and performance. You have to worry about anchoring and adjusting, which introduces a whole slew of human error and judgment calls. And overall, it also, and I think the biggest thing is that it doesn't work the more volatile the markets become. The more the surge of volume drastically reduces VWAP's performance. But it can be quickly improved, right? You just have to know what VWAP's weaknesses are and you improve them. We did that with LWAP. And LWAP does seem to be quite the viable candidate for replacing VWAP. And it is super easy. It's just, I mean, look at it. Tell me that's not the easiest thing in the world to trade. Short. Keep going. You might go long, and you would still make a profit, and then you would go back to being short. You would go long there, maybe not make a profit, probably not make a profit here, but then you would go short again. So boop, you've been short the predominant of this movement. How much easier do you need it to get? So thank you for coming, guys. There were some technical difficulties during the live chat, so I decided to refilm this as a standalone YouTube video. And that's all I have for you guys. Thank you for coming. I look forward to seeing you guys. Next week's live chat is about market makers. It is on Zoom, but I put the link in the Discord, so I highly recommend checking it out. And that's all I have for you guys. Thank you for coming, and I'll see you guys next time. Happy trading. Bye.